Algonquin Power and Utilities Corp. or AQN is in trouble. The company is facing serious financial challenges and investors are worried. Once considered a reliable dividend-paying stock, Algonquin has stumbled. They have cut their dividend and their debt is high. The company is restructuring and selling assets. Is there a light at the end of the tunnel? Algonquin is a regulated utility and renewable energy company. They own and operate a portfolio of power generation assets across North America. Their business mix includes renewable energy sources like wind, solar, and hydro, and they also operate traditional utilities. The company's problems are multifaceted. They aggressively acquired companies, which led to high debt. Now, interest rates are rising, making their debt more expensive. At the same time, operational challenges and regulatory hurdles are impacting profitability. Algonquin's situation is a cautionary tale. It highlights the importance of careful financial management and shows the risks of aggressive growth strategies. Investors are now questioning the company's future. Can they overcome these challenges? Only time will tell.
Dividend cuts are never good news. For income-oriented investors, it's a major blow. Algonquin's decision to slash its dividend sent shockwaves through the market. It was a clear sign of distress. Investors rely on consistent income from dividends, and the cut eroded trust. The dividend cut wasn't a surprise to everyone. Analysts had been warning about it for months. Algonquin's high payout ratio was unsustainable, and their debt was becoming unmanageable. The company had to take drastic action. The dividend cut was a necessary evil. It will save the company money, which they can use to pay down debt. It will also give them more financial flexibility. It's a bitter pill to swallow for investors, but it might be the right move in the long run. Algonquin needs to regain the trust of investors. They need to improve their financial health and focus on sustainable growth. Only then will investors regain confidence.
Algonquin's aggressive acquisition spree came at a price. To fund their expansion, they took on a mountain of debt. This strategy worked well when interest rates were low, but the economic landscape has changed. Rising interest rates have become a major headache. Algonquin's debt has become much more expensive to service, and this is eating into their profits. It limits their ability to invest in future growth. The company is now stuck between a rock and a hard place. They need to reduce debt, but they also need to invest in their business. It's a delicate balancing act. Algonquin is taking steps to address their debt. They're selling off non-core assets and cutting capital expenditures. Will it be enough to right the ship? Only time will tell.
Algonquin is changing its tune. Gone are the days of aggressive acquisitions. The company is now focused on conservative growth. They're tightening their belts. The new strategy is all about focusing on their core businesses. They are investing in existing assets and improving operational efficiency. They're also prioritizing debt reduction. This new approach is a stark contrast to their previous strategy, but it's a necessary course correction. Algonquin needs to stabilize its financial position. The company is optimistic about the future. They believe this new strategy will lead to sustainable growth and create long-term value for shareholders.
Section 5. Navigating regulatory and operational headwinds. Algonquin faces challenges beyond their financial woes. The regulatory environment is becoming increasingly complex. This is particularly true in the renewable energy sector. Changes in government policies and regulations can impact profitability. Delays in project approvals and permitting can disrupt operations. Algonquin needs to be adaptable. On top of regulatory hurdles, the company has also faced operational inefficiencies. This has further weighed on their financial performance. Algonquin is working to address these challenges. They are strengthening their relationships with regulators. They are streamlining their operations. They are investing in new technologies.
Section 6. Assessing the damage. Algonquin stock valuation. Algonquin stock has taken a beating. The dividend cut and financial woes have spooked investors. The stock has plummeted from its highs. But is the stock undervalued? Or is the market accurately reflecting the risks? That's the million-dollar question. Some analysts believe the stock is now a bargain. They point to the company's strong asset base. They see potential for a turnaround. Others are more cautious. They're concerned about the debt. They're unsure about the long-term growth prospects. Algonquin stock is not for the faint of heart. It's a high-risk, high-reward proposition. Investors need to carefully weigh the risk and potential rewards before investing.
Section 7. A glimmer of hope, potential for recovery. Despite the challenges, there are glimmers of hope for Algonquin. The company is taking steps in the right direction. They're addressing their debt. They're focusing on their core businesses. Algonquin's management team is experienced. They're committed to turning the company around. They have a plan in place. Now they need to execute. The transition won't be easy. There will be bumps along the road. But if Algonquin can successfully navigate these challenges, there's potential for recovery. The company has valuable assets. They operate in a growing sector. With the right strategy and execution, they can regain their footing.
Section 8. Proceed with caution. The road ahead for Algonquin Power. Algonquin Power is at a crossroads. The company is facing significant challenges. Their future is uncertain. Investors should proceed with caution. The dividend cut was a necessary but painful step. The high debt levels are a major concern. The company's ability to navigate a changing regulatory landscape and address operational inefficiencies will be crucial. Algonquin's stock price is depressed. This could present a buying opportunity for risk-tolerant investors. However, it's important to remember that there's no guarantee of a recovery. Algonquin's story is a reminder that even seemingly stable companies can stumble. It highlights the importance of diversification. Investors should never put all their eggs in one basket.